Hello everyone, welcome to lecture number 4. We'll cover question number 7 and 8 today. 7 I'll be doing right now and 8 will be your homework. Similar to question number 8, we have already done a question in Zoom session. So you can refer that and try the solution on your own. The solution of question 8 will be uploaded on the You Will Learn app. So right now we take up with question number 7, look at it. Munshi Limited is desirous of purchasing the business of Devi Limited. On 31/3/2019, the financial position is as follows. Now, equity share capital is not an external liability, it won't be included. General reserve is not an external liability, it won't be included. We are talking about capital employed. In capital employed, which things from balance sheet should be included if we find it by indirect method. Secured loan is an external liability, so that will be subtracted. Secured against land is the adjustment given in bracket or disclosure given in bracket. Short-term loan is an external liability, it will be subtracted. Creditors are external liability, it will be subtracted. Goodwill itself is not included in the valuation of goodwill. Land is a trade asset, it will be included. Plant and machinery is a trade asset, it will be included. Furniture is a trade asset, it will be included. Stock is a trade asset, it will be included. Debtors are trade assets, they will be included. Bills receivables are trade assets, they will be included. Cash at bank is trade asset, it will be included. Okay, so only goodwill will not be included. Now the profits of the company before managerial remuneration rupees 20,000 per annum and taxation. So before tax, as such we have to make all the adjustments in profit before tax only are as follows. Now these are before managerial remuneration also. So it means in managerial remuneration of 20,000 per annum is not included in any of the profits given below. And managerial remuneration is a regular business expense, it should be included. So if managerial remuneration is included in all these profits, what will happen to the profits? I repeat, if managerial remuneration we include in all these profits, what will happen to the profits? The profits will decrease. So we will minus this managerial remuneration in all the year's profits. Okay, we will minus this managerial remuneration in all the year's profits. Now profits are 14 to 15, 1,80,000. 15 to 16, 1,90,000. 16 to 17, 2,60,000, including speculative profit of 40,000. Now speculation is like gambling, one-time profit. It is not going to occur again and again. So in business, if you take a benefit of any opportunity, you earn that profit, but that opportunity may not come again and again. For example, an opportunity to buy a property at very less price, opportunity to buy the raw material at very less price. These all opportunities are one time, they don't come again and again. So these are called speculations. It is not a regular profit, we should remove it from the profits. If you remove it, the profits will decrease, so we will minus it from the profit of 16 to 17. Then 2017 to 18, 2,50,000, including 10,000 profit on sale of fixed asset. Now fixed asset, make it fixed assets. These are also not earned every year. Okay, fixed assets are not revenue, but they are capital income. So profit on sale of fixed asset being a capital income, it should not be included in regular profits. If you remove that from the profits, abnormal profit it is. If you remove that, then again the profits will decrease. So we will minus it from profits of 17 to 18. 18 to 19, 2,80,000. Now casual income. Casual means one time. You don't earn it again and again. Of 3,000 was included in the profit of 14 to 15. See, which can never be expected in future because it's a casual income, one-time income. In income tax you studied casual incomes, winnings from horse races, etc. So these are all one-time income, you don't earn them again and again. So you will minus it from the profits of 14 to 15. Profits of 2018 to 19, this 2,80,000 were reduced by 1,000 as a result of an extraordinary loss by fire. Extraordinary loss by fire, again, fire is not expected every year in the business. So if you remove this loss, 1,000, the profits will increase. Okay, if you remove the income, the profit will decrease, so we subtract. But if you remove the loss, which is not expected again and again, the profits will decrease. So this amount the profits will increase. If you remove the loss, the profits will increase. So you will add it in the profits of 18 to 19. after the acquisition. Okay, after the acquisition of Munshi Limited, as we have seen in the beginning that Munshi Limited has purchased Devi Limited. So after the acquisition of Munshi Limited, has to pay insurance premium amounting to 1200 per annum, which was not paid by the transferor, means the selling company in past. So you have to pay after the acquisition, means this is a future expected expense. Step number 3 will come across here for the first time now. What did we study in step number 3? After finding the average profits, okay, after finding the average profits, what we have to do in step number 3? Step number 3, yeah. After finding the average profits, add any future expected income and subtract any future expected expense. Here it is a future expected expense, so we will minus it, but we will minus it from average profits. As it is a future expected expense, we will minus it from average profits. The company falls in the tax bracket of 26%. So either for all the years you can minus 26%, or even this you can directly minus it from average profits, because for all the years the tax rate is same. Past questions we have seen different tax rate for every year, so we minus it from respective years profits only. But here overall the tax bracket is 26%, so we can directly minus it from average profits. The company is engaged in similar business, normally on 15% per annum. This is normal rate of return. Calculate the value of goodwill on the basis of 4 years purchase of super profits, and see, it is clearly given that the capital employed may be taken as on 31/3/2019, means clearly given that we have to use closing capital employed. Okay, we have to use closing capital employed for the purpose of valuation of goodwill. So let us start solving this now. All of you take out your notebooks, give the heading question number 7, and all of you make this table. Which table? Particulars, and which are the 4 years given? 14 to 15 till 18 to 19. So all of you make this table, particulars, and then 14 to 15 onwards 18 to 19. Yes, I hope everyone has done it now. Let us start with it. Be attentive. Very first profit before tax given in the beginning are, see here, 1,80,000, 1,90,000, 260, 250, 280. Okay, 180, 190, 260, 250, 280. 1,80,000, 1,90,000, 2,60,000, 2,80,000, 2,50,000, and 2,80,000. Now let us go with the adjustments one by one. Very first, in the beginning itself, this 20,000 of remuneration you have to minus in all the years. Okay, managerial remuneration 20,000 we have to minus in all the years. So less managerial remuneration we have to minus 20,000 in all the years. I hope everyone has done that. Now next adjustment, after that, speculative profit of 40,000 we have to minus from 16 to 17's profit, less speculative profit 40,000 we have to minus from 16 to 17's profits. Then 10,000 of profit on sale of asset we have to minus from 17 to 18's profit, less profit on sale of assets from 17 to 18's profits we have to minus 10,000. Then okay, adjustment 1, casual income of 3,000 we have to minus from 14 to 15's profits, less casual income 3,000 we have to minus from 14 to 15's profits. Then 1,000 we have to plus in 18 to 19's profits as extraordinary loss by fire. So now this we have to plus add extraordinary loss by fire. 1,000 we have to add in 18 to 19's profits. Then third one we have to minus from average profits. Fourth also we have to minus from average profits. So all the adjustments are done. We can find the adjusted profits before tax. And as we discussed, tax also we will minus from average only. So first we find adjusted profits before tax. 1,80,000 minus 20, 1,60,000 minus 3, 1,57,000, 1,90,000 minus 20, 1,70,000, 2,60,000 minus 20, 240 minus 40, 2 lakhs, 2,50,000 minus 20, 2,30,000 minus 10, 2,20,000, 2,80,000 minus 20, 2,60,000 minus 1, 2,59,000. Okay. So these are the profits. Now you all can see in the question nothing is mentioned whether we have to use simple average or weighted average, but over here you all can see that the profits are showing an increasing trend. 1,57,000 to 170 it's increasing, 170 to 2 lakhs is increasing, 2 lakhs to 220 is increasing, and 220 to 259 is also increasing. Since it is showing an increasing trend, we will be finding the weighted average of profits. So we'll make the columns of years, profits, adjusted profits before tax, weights, and weighted average profits or weighted profits. All of you make these columns. Now years are from 2014 to 15 till 18 to 19. So 2014 to 15, 2015 to 16, 2016 to 17, 2017 to 18, and 2018 to 19. Thereafter, adjusted profits before tax 1,57,000, 1,70,000, 2 lakhs, 2,20,000, and 2,59,000. Now weights are, we will give 1, 2, 3, 4 and 5. Now weighted profits. So all of you do it. 1,57,000 into 1 and put it in M plus in your calculator. Use the memory functions. So directly we'll get 1,57,000 added in the memory of calculator. Then do 1,70,000 into 2 and put it in M plus. 3,40,000. Then 2 lakhs into 3, M plus 6 lakhs. Then 2,20,000 into 4, M plus 8,80,000. And then 2,59,000 into 5, M plus 12,95,000. Now you all directly press MR or MRC in your calculator and you'll find 32,72,000 as the total. So directly you get the total if you put it in the memory functions. Okay. Now Total of this will be 15. Okay. Now, weighted average profits we have to find. So, formula will be weighted average profits is equal to weighted average profits is equal to total weighted profits divided by total of weights. Now, total weighted profits we have obtained 32,72,000 divided by total weights we have obtained 15. So 32,72,000 divided by 15. We get 2,18,133. 2,18,133. Now from this we have to minus as per adjustment 3 1,200 per annum of future insurance premium. So minus future insurance premium minus future insurance premium that is 1,200. Here we'll minus it. We'll get 216,933. Okay, now from that we'll minus the tax. This is the profit before tax, so we will minus tax, which is given at the rate of 26% in the question. You all can see that adjustment number 4. The tax rate is minus 26%. Actually, we will minus it from adjusted profits or average profits. So into 26% tax will come to 56,402.6, means we'll round it up to 56,403. 56,403. And if you minus that, then you will obtain 1,60,530. 1,60,530. These are average future maintainable profits. Okay, average future maintainable profits. So first step is done. We have obtained average future maintainable profits. Now we find capital employed. Second step to find the goodwill, what we require is capital employed. And in super profits method we do require it. Only in simple profits we don't require capital employed. In all other methods we are required to calculate capital employed. Now here the formula is fair value of all trade assets. Okay, fair value of all trade assets. So from the asset side, land 3,50,000. Okay, first we start with land of 3,50,000. No other values are given in the adjustments, so directly we have to take them into consideration. Then after land we have plant and machinery 2 lakhs. Okay, plant and machinery 2 lakhs. Then after plant and machinery we have furniture 50,000. Furniture 50,000. Then after furniture we have stock 1,50,000. stock 1,50,000. Then we have debtors 1,25,000. Debtors 1,25,000. Then we have bills receivables 75,000 and cash at bank 50,000. Bills receivables 75,000 and cash at bank 50,000. Now we'll do the total. 3,50,000 plus 2 lakhs plus 50,000 plus 1,50,000 plus 1,25,000 plus 75,000 plus 50,000. So 10 lakhs. Okay, total assets are 10 lakhs. You will mark it as A. From that we have to minus fair value of external liabilities. So less fair value of external liabilities. Now in that we will include secured loans of 2 lakhs, okay, secured loans 2 lakhs, then short term loans of 1 lakh, short term loans of 1 lakh, and then creditors of 50,000. Creditors of 50,000. So 3,50,000 B. Now capital employed will be A minus B, and this is the closing capital employed, and that itself we have to use as mentioned in the question. So 10 lakhs minus 3,50,000, 6,50,000 is the capital employed we are supposed to use in this question. Now we have to apply which method? Super profits method for goodwill. So what will be the next step after finding capital employed? For super profits method, we will require normal profits. Normal profits will be equal to capital employed into normal rate of return. Okay, capital employed into normal rate of return. That is equal to 6,50,000 into normal rate of return in the question is how much? See the last adjustment after adjustment for 15% per annum. So 6,50,000 into 15%. Do it 6,50,000 into 15%. That is 97,500. After we find normal profits, then we will find super profits. So how will we find super profits? Super profits is equal to average future maintainable profits minus normal profits. Okay, average future maintainable profits minus normal profits. So average future maintainable profits are 1,60,530. Okay, 1,60,530 minus normal profits are 97,500. So 1,60,530 minus 97,500, that is 63030. These are super profits, and now we can find goodwill by super profits. So what will that goodwill be equal to? Goodwill is equal to super profits into number of years purchase. Okay, super profits into number of years purchase. See, in the beginning, how many years purchase is it given in the question? 4 years purchase is given in the question. So super profits we obtained 63030 multiplied by 4 years purchase. So goodwill comes to 252120. I hope everyone is clear with this question. Now question number 8 we will discuss, and it will be your homework, and if you get confused, you can refer to this solution which we have already done in the last Zoom session 6 question 12. This video lecture also I have uploaded in the You Will Learn app. So first you can refer to this solution, those who have not attended the Zoom session. The question is exactly similar. Okay, this solution you'll find over here. First you attend that, then you try question number 8 on your own, and the solution of this question number 8 I will upload on You Will Learn app, so you can verify whether it's right or not. Question I am discussing right now in front of you, it is similar to question 12 which we had done in the Zoom session. Following is the financial position of X Limited as on 31st March 2019. Equity shares of 10 each 18 lakhs is not an external liability, it won't be included in capital employed. 5,008% preference shares of 100 each is not an external liability. Capital reserve, general reserve also belong to the owners, they are not external liabilities. Secured debentures we will minus, it is an external liability. Trade creditors will minus, it is an external liability. Goodwill itself is not included in the valuation of goodwill. Land is a trade asset, building is a trade asset, plant and machinery is a trade asset. Now investment in 5% government security. So government security means it's a non-trade asset, and non-trade asset won't be included. The money is not going into the business. Trade asset means the money should be invested in your own business. Here you are investing in government security, so it's a non-trade asset. However, this 1,50,000's 5% interest will also be earned, which would be included in our profits. So 1,50,000's 5%, 7,500 is the income from non-trade assets, which we will have to minus in all the years. Okay, either you minus it in all the years or you directly minus it from the average. The tax rate is ignore taxation, so you can directly even minus it from the average profits. Okay, if you don't minus it from all the years and directly you minus it from average profits, then also your answer will come correct. Either you minus it from all the years or you directly minus it from the average profits, your answer will come same. Okay, stock is 10 lakhs trade asset, debtors are 5 lakhs trade asset, cash in bank are 4,50,000 trade assets. The profit of the company before considering managerial cost of 20,000 per annum. Just now we did in previous question also, and in question 12 also we have done that. You will minus this 20,000 in all the years. Okay, you will minus this 20,000 in all the years profits, as it is before managerial consideration, remuneration or cost. 2014 to 15, 3 lakh includes 30,000 of non-recurring income. Non-recurring means it is not going to occur again and again. So we should not include such income. If you remove such income, the profits will decrease. So we will minus from the profits. 2015 to 16, 3 lakh 50,000, which includes loss on sale of machinery, 50,000. In previous question also we did this. It's a capital loss, one-time loss. We are not going to incur that again and again. If you remove the loss, we have to remove it. If you remove the loss, the profits will increase. So we will plus in the profits of 15 to 16. 16 to 17, 4 lakhs, including speculative profit of 50,000. I told you speculation is also one-time game like gambling. Okay, you don't occur it again and again. So if you remove that profit, the profits will decrease. So you'll minus from profits of 16 to 17. 17 to 18, 5 lakhs, and 18 to 19, 6 lakhs. Now, closing stock of 2014 to 15 was undervalued by 30,000. You all can make that rough working on your own. Now I'm directly explaining it over orally only. Closing stock comes on the credit side. Credit side undervalued means we have taken less. So credit side, if you take the original value which is more, the profits will increase. So you will plus in the profits of 2014 to 15, and same will become opening stock of next year. So you'll minus it from the profits of 15 to 16. I repeat it. Closing stock comes on the credit side. Credit side, if we have undervalued and taken less. Okay, undervalued and taken less. If you bring it back to the original value, credit side, if you increase any amount, profits will also increase. Or else we always have been making this kind of workings which you can obviously make and understand that credit side we have taken less. If you take the actual, the profits would increase. So we have been doing these workings in past questions. You can always make this working in rough to understand the impact on profits. Same way, opening stock for the year 17 to 18 was undervalued. Opposite effect, closing stock undervalued will be plus. So opening stock undervalued we will minus in 2017 to 18. And opening stock of that year will be the closing stock of previous year. Previous year means you will plus in 2016 to 17. Okay, opening stock of 17, 18 would be the closing stock of 16 to 17. So in that year you will plus it. On 1/10/17 means it will affect the year 17 to 18. Major repair of 50,000 was made in respect of plant which was charged to P&L account. The said sum is to be capitalized now. Means we have to remove it from P&L debit side and take it on the asset side. If you remove it from P&L account debit side, you have to, if you remove it, the profits will increase. So you have to plus in the profits of 17 to 18. Debit side of P&L, if you remove that major repair expense, the profit will increase. So we have to plus it. And its depreciation we have to minus in 2017 to 18 as well as 2018 to 19. Working of depreciation will have to be done as we had done even in question number 12. So this kind of workings of major repairs will be first done by you to find the depreciation of 2 years, and those depreciations you'll minus in 17 to 18 and 18 to 19. Land was revalued at 4,50,000, so we will not take 2,50,000. We have to take fair value of trade assets. So we will take 4,50,000 when we find capital employed. 30% off, make it off. The amount invested in building is treated as non-trade assets. 30% is non-trade assets, so can we say 70% is trade asset? We take fair value of all trade assets. So this building, when you take in capital employed, you'll take only 70% as trade assets. 2,70% you'll take only 1,40,000 when you find the capital employed. On which means on this 30% non-trade asset, rent of 20,000 is realized annually. That is income from non-trade asset. So you'll minus it in all the years, or alternatively you can minus it from average. Okay, 20,000 rupees, just like this income of 7,500 which is non-trade asset, we minus it same way. This rent income is also income from non-trade asset. We have given the property on rent. We are not using it for business purpose. So this rent, when we find goodwill, we have to remove it from the profits. The profits will increase, okay, decrease, because rent is an income. So if we remove the rent income, the profits will decrease. So we'll minus it either in all the years profit or average profit. Your answer will come same. Normal rate of return on closing trading capital employed, clearly given closing. So here also you don't have to find average capital employed. You do the calculation on the basis of closing only. As on 31st March 2019 for valuation of goodwill is 10% normal rate of return. And present value of annuity for 1 rupee for 5 years or at 10% is 3.78. This will be used in annuity method. You will find goodwill by 4 different methods. All the 4 methods are asked. Simple profit, 5 years purchase everywhere, okay. Super profits, again 5 years purchase. Capitalization is also asked, and annuity method is also asked. All of you try question number 8 entirely on your own, and its solution you will find in You Will Learn app. So all the major questions are over now. Just one more last lecture will come for important theory points from this chapter, plus some different categorization of types of goodwill I have to discuss in theory, which can be asked in MCQ. So one more last lecture of goodwill after this and the chapter will get over. That'll be all for this lecture. Bye everyone. Take care. See you in the next lecture.